All right, everybody, welcome back. We are taking another deep dive today
Yeah.
into mutual funds,
Yes.
which, it's an area a lot of people kind of get into, and they're not exactly sure what they are,
Yeah.
I think
Absolutely.
we've got a great simple guide that we're going to use to kind of break down mutual fund investing. So we're going to kind of be like your cheat sheet for understanding mutual funds.
Absolutely.
So imagine you're dipping your toes into investing for the first time.
Right?
You're probably feeling a mix of like excitement
Yeah.
and maybe a little apprehension.
Oh, yeah. A little overwhelmed for sure.
And where do I even begin?
Totally.
So that's what we're going to do today.
Exactly.
We're going to break it down.
We are.
No jargon allowed.
Yeah.
So.
I like that. No jargon allowed. That's good.
Yeah.
I'm going to use that one.
So let's start with the basics.
Okay.
What exactly is the mutual fund? I feel like I've heard people toss that term around. I'm like, I don't really know what that is.
Yeah. No, it can definitely sound intimidating when you first hear it, right? Like mutual fund. What is that?
Yeah.
But honestly, it's a lot simpler than it sounds.
Yeah.
Think of it this way.
Okay.
You want to build this epic Lego set.
Okay.
One of those massive ones with thousands of pieces.
I'm with you.
But you might not have all the Lego bricks yourself.
Right.
So you team up with some friends.
Okay.
Other Lego enthusiasts. And everyone chips in their bricks.
Okay.
And together you create this awesome structure.
Right. So instead of Legos, we're talking about money.
Exactly.
Okay.
So a mutual fund is kind of like that Lego club.
Okay.
It pools money from many investors to buy a diverse collection of assets.
Okay.
These assets could be stocks, bonds, even real estate.
Okay.
And there's a professional fund manager who's kind of like the master builder. They decide which assets to buy and sell.
Based on
the fund's strategy.
Okay.
So they're making those decisions for the whole group.
So it's like having a financial expert
Yes.
build my investment portfolio for me.
Exactly.
That sounds pretty handy.
It can be.
But why not just buy stocks directly?
Yeah, that's a good question.
What's so special about this pooling money thing?
That's where diversification comes in.
Okay.
And this is a really important concept
for
any investor.
Correct.
Remember that Lego set?
Yeah.
If you only have one type of brick,
right,
your creation would be pretty limited, right?
It would be boring.
Exactly.
You couldn't do that much with it.
No, you couldn't build anything very interesting.
Yeah.
So diversification is all about spreading your risk by investing in a variety of assets.
Okay.
So if one investment doesn't perform well, the others can help cushion the blow.
That makes sense. It's like that saying, don't put all your eggs in one basket.
Exactly.
Okay, so we know what mutual funds are.
Right.
We know why diversification is so important. But there were so many different types of mutual funds.
Oh, yeah.
How do we even begin to choose?
I know. It can definitely feel overwhelming.
Yeah.
It's kind of like walking into a giant ice cream shop with 100 different flavors.
Right.
You wouldn't just randomly grab a scoop, would you?
No.
No. You'd think about what kind of flavors you enjoy.
Exactly.
Same goes for mutual funds.
Okay.
There are different flavors to suit different tastes.
I like where this is going.
Yeah.
So walk me through this mutual fund flavor menu.
All right, let's do it.
What are our options?
So let's start with equity funds.
Okay.
These funds invest primarily in stocks.
Okay.
And remember how we talked about diversification being like building with different Lego bricks?
Yes.
Well, equity funds are kind of like using all those colorful bricks to build something exciting. Okay. They have the potential for high returns.
All right.
But they also come with higher risk.
Okay, so higher risk, higher reward.
Exactly. It's that classic trade-off.
Okay.
So they're a good fit for long-term goals, like retirement, where you have time to ride out any ups and downs in the market.
So equity funds are, for those of us who, a bit of a thrill ride.
Exactly. If you're a thrill seeker,
Yeah.
then equity funds might be a good option.
What about folks who prefer a smoother, more predictable journey?
Right. Then we have bond funds.
Okay.
They invest mainly in bonds, which are generally considered less risky than stocks.
Okay.
So bond funds, they offer steadier growth.
Okay.
But their returns might be lower than equity funds over the long haul.
Right.
So they're a good choice for more conservative investors or for shorter-term goals where you don't want to risk big fluctuations.
Got it. So equity funds. for the adventurous bond funds.
Yep.
For the steady goer.
Exactly.
What if I'm somewhere in between? I want some excitement.
Yeah.
But I don't want to lose sleep over every market dip.
Okay, I hear you. There are definitely options for that too.
Okay, good.
So that's where balance funds come in.
Okay.
They blend stocks and bonds.
Okay.
Aiming for a balance.
Right.
Between growth and stability.
Okay, so kind of a best of both worlds.
Exactly. A little bit of excitement.
Yeah.
A little bit of peace of mind.
I'm really liking these analogies.
Good. I'm glad.
That makes it so much easier to understand.
Awesome.
Are there any other flavors on the menu?
There is one more I want to highlight.
Okay.
Index funds.
Index funds.
Yes.
Have you heard of those?
I have heard of them, but I'm not really sure what they are.
Okay, so index funds are kind of like those popular recipes that everyone loves and copies.
Okay.
So instead of trying to beat the market.
Yeah. Index funds simply track a specific market index.
Okay.
Like the S&P 500.
Mm-hmm.
So they aim to match the index's performance.
Got it.
Which can be a really cost-effective and efficient way to invest.
So it's like following a proven recipe.
Yeah.
Instead of trying to come up with my own.
Exactly. You're not trying to reinvent the wheel.
Right.
You're just following the recipe that's already worked well.
Okay. I'm all about making things easier.
I hear you.
So we've got equity funds, bond funds,
right,
balance funds, and index funds.
Yes.
What do we need to consider before we place our order?
Good question.
So to speak. So now it's time to talk about the nitty-gritty details.
Okay.
Fees, performance, and risk.
Okay.
So think of it like buying a car.
Okay.
You wouldn't just look at the color and the style, would you?
No, I would not.
You'd consider the price.
Right.
The gas mileage.
Yeah.
The safety.
You want to do your research before you commit.
Right.
All right, so let's start with fees.
Yeah, let's talk about those.
Okay, so when you invest in a mutual fund, you'll typically pay an expense ratio.
Okay.
And this is an annual fee that covers the fund's operating costs, like paying the fund manager and administrative expenses. Expense ratios vary.
Okay.
So you definitely want to compare those.
Right. Lower is better, I'm guessing.
Yeah. Generally, a lower expense ratio means more of your money is actually working for you.
Yeah, that makes sense.
Okay. And then there are load fees.
Load fees.
Yeah. Which are essentially sales charges.
Okay.
Some funds charge a fee when you buy shares. That's called a front-end load.
Okay.
And some charge a fee when you sell shares.
All right.
That's a back-end load.
So it's kind of like comparing sticker prices and hidden fees
exactly.
with cars.
You got it.
All right. What about performance?
Okay, performance.
How can we gauge a fund's potential?
So it's natural to want to look at a fund's past performance.
Right.
It's like checking restaurant reviews before you go eat there.
Exactly.
You want to know if other people have had a good experience. But it's important to remember that past performance isn't a guarantee of future results.
Of course.
Right? It's more like a track record.
Yeah.
It gives you an idea
of
how the fund has navigated different market conditions in the past.
So I shouldn't just look at the best performing fund.
Exactly, right? You want to look beyond just the flashy headlines and dig a little deeper.
Yeah, because what's going to happen in the future?
Right.
Who knows?
Exactly. Nobody can predict the future.
Okay, so you mentioned risk earlier.
Yes.
Isn't that something we need to factor in?
Absolutely.
Okay.
Risk tolerance is really important. Some people are totally comfortable with a little more turbulence in their investments.
Okay. While others prefer a much smoother ride.
Right.
So generally equity funds, because they're tied to the stock market, are considered riskier than bond funds.
Okay.
But within each category, there's a whole spectrum of risk levels.
So it's really about knowing myself as an investor.
Knowing your comfort level.
Yeah.
And choosing a fund that aligns with that.
Okay. So let's say I've considered the fees. I've checked the performance.
Right.
I'm comfortable with the risk.
Okay.
Anything else I need to know?
There's one more important thing.
Okay.
You need to understand the fund's investment objective.
Okay.
This is kind of like reading the instructions before you start building a Lego set.
Okay.
It's not the most exciting part,
right,
but it can save you a lot of trouble down the road.
So no skipping the instruction manual.
Exactly.
What about the fund manager?
Okay, yeah.
Do they actually matter that much?
They do.
Remember our master builder analogy?
Yes.
The fund manager is the one making those investment decisions.
Right.
So their expertise and their approach play a big role.
So it's like choosing a captain.
Yes.
For my investment ship.
Exactly.
So let's say I've done all my research.
Okay.
I've picked my mutual fund, invested my money.
Right.
Am I done?
Well, not quite.
Okay.
Investing isn't a set it and forget it kind of thing.
Right.
It's more like tending a garden.
Okay.
You know, you need to check on your plants.
Right.
Do some pruning.
Yeah.
Make sure they're getting enough sunlight.
Make sure they're not dying.
Exactly. Same with your investments.
Okay.
You need to review your portfolio periodically.
Right.
Make sure your funds are still aligned with your goals.
Okay.
And, you know, make adjustments if needed.
Regular checkups are key.
Yes, they are.
All right. So we've learned
what
mutual funds are.
Mm-hmm.
We've explored all these different types.
Yeah.
We talked about fees, performance.
Yeah.
Risk the fund manager.
It's a lot to take in.
It's a lot.
Yeah.
But I feel like we've covered it all.
I think so, too.
I feel like I'm starting to speak mutual fund now.
That's awesome.
But I do have one last question.
Okay, shoot.
Let's say I've chosen my fund.
Yeah.
Invested my money.
Mm-hmm.
Am I just done now?
Okay, so that's a really important point.
Okay.
Investing isn't a one-time thing.
Okay.
It's an ongoing process.
Right.
So you don't want to just set it and forget it.
Okay.
You need to stay engaged.
Okay.
And make sure your investments are still on track.
Got it.
So even after you've invested,
yeah,
there's still work to be done.
Okay, that makes sense.
Yeah.
We've covered a lot of ground here.
We have.
I feel like everyone listening
Yeah.
has a solid foundation for understanding mutual funds.
I hope so.
But investing always involves some level of risk.
Absolutely.
So, you know, do your own research.
Yes. Always a good idea.
Talk to a financial expert if you need to.
Definitely.
And just be smart about it.
Yeah. Be informed.
Here's a question for you to ponder.
Okay.
Based on everything we've discussed today,
yeah.
What type of mutual fund
Mm-hmm.
might be the best fit for your financial goals
Right.
and your risk tolerance?
Good question.
Keep exploring.
Yeah.
Keep learning. And happy investing, everyone.
Happy investing.
We'll see you next time.
See you later.